NVIDIA is reporting its earnings on the 22nd of May, so is it a great time to buy now? We already see indications from Wall Street calling it a strong buy and Seeking Alpha giving it a buy rating. Today's episode we are going to do a deep dive taking a look. We'll also touch upon how they performed in the last quarter, setting up our expectation for how we think they will report in a very short time. We're also going to take a look at some of their new products that they are bringing out, talking about how they will continue to increase both their top line as well as their margins quarter on quarter. We're also going to look at some insider selling that we have noted around 20 million just a few days ago. We'll also look towards the institutions to understand if they continue to buy quarter on quarter, and we'll look at not just the dividend safety, which is a very small part of this business, but also their fundamental metrics, their free cash flow, their sales growth, their ROIC, as well as their debt levels. And before we do all of this, we also want to remind you that we will not just only run them through the valuation model so we get to our own intrinsic value as well as our acceptable buy price, considering the margin of safety and looking at Wall Street's forecast over the next 12 months. But we'll also look at the discounted cash flow model in detail. We're going to take a look at 3 different growth rates so you can understand where the expectations are coming from, a low, medium, and high. So let's jump into our analysis, and the first thing we do want to state that this has been giving an updated buy rating with a price target by one analyst at $1,500, which is around a 60 to 70% upside from the current trading price, and it is already up over 211% just in the last 12 months. Now, not everything is always positive. 2 companies, very similar industries, Super Microcomputers, did report not too long ago. Since then, they are down nearly 12%, and we can say the same for ARM Holdings, also recently reported down around 14%. So it will be interesting to see how NVIDIA performs, but we're going to do our deep dive to understand if now is a great time to continue to add to our winners that has performed very strongly. Now, over the last year, yes, it is up over 211%, but if you have been a longer-term shareholder, you can see it would be up 19,900 and nearly 16%. A phenomenal company. We can also see it isn't too far off its 52-week high as well. As we said at the beginning, it does have one strong buy rating from Wall Street, one buy from Seeking Alpha, and we also note from quant analysts they do consider this to be a hold. So let's do a very quick look just to remind ourselves of how they've performed over the longer term. And as always, on the top line, revenue for normal companies 3 to 7%, but NVIDIA has been growing at a very rapid rate. In fact, 10 years ago, they reported 4.7 billion on their top line. Their latest annual account, so January 2024, just under 61 million. And when we look at it on a graphical basis, we can see some incredible growth, although we do note the majority of this has just come from the last few years. And with AI expanding into different areas that we'll look at, including robotics, it does look like NVIDIA could really be there to capture a lot of this market share. In fact, it is a significant amount that we will have talked about very soon on this episode. In terms of bottom line, incredible 631 million reported in January 2015. Latest annual accounts just under 30 billion. So not just the top line that has increased at a very, very rapid rate, but also as we see their bottom line, although we do know the majority of this was 23 to 24, it is a very fast growing company. Now, in terms of looking at their balance sheet, a very quick update to the health of this company. Total cash versus total debt, well, 4.6 billion in 2015. They now hold a significant amount in short-term investments in cash, just under 26 million. And similar to their other numbers, it has been increasing over the longer term. Now, there isn't too much we can deduce from the cash, but we like to compare it to their total debt numerically and directionally. And we can see that even though their total debt has increased rapidly, 1.4 billion to 11 billion, we do note that their cash would be able to pay that off within 1 day. So no real worries there, but again, we can see their total debt has been increasing over the longer term. Now, what we want to do is have a quick look at their track record on their earnings per share, how they perform versus analyst estimates and the expectation moving forwards. What we can see is over the last 4 quarters, they have beat every single time. That is a very positive sign, a 100% track record, and they have beaten, especially over the last 3 quarters, by quite some distance, 53 cents and 63 cents as well as 61 in Q2 of 2024. On top of that, we do note the next 2 quarters estimated to be a year-on-year increase on the earnings per share, 409%, 120%, with the next 2 quarters still strong double digits. So very impressive, and hopefully they will continue to beat those analyst targets. Now, in terms of what those numbers are, we can have a very quick look in terms of the analysts, their expectations. So on average, in terms of how they're looking for the earnings per share, 555 is the target for this quarter that is coming up. And in terms of their revenue on an average basis, at just under 25 billion. So we'll also take a look at how they performed in their just more recent one, but we can see the expectation there is, when we do compare it on a year-on-year growth, 275%. So very rapid indeed. And the expectation for their revenue to increase in 2025, 84%, and 2026, 25%. So it is expected to slow down. Nonetheless, it is expected to be very, very rapid in terms of that growth. Just a year ago, their earnings per share, 98 cents. And as we can see, the expectation for this quarter, 555. So a lot of people, you can sit there and warrant that this is a company that should be very fast growing given the forward PE and given the valuation. But as always, we do need to see them beat those targets and have some very strong forward guidance. Now, in terms of valuation, no surprises here. They do get that F grade. When we do take a look, 35.82 on a P non-GAAP basis, with the sector median at 23.6. So it is in fact richer by around 52%. But as I just mentioned, you could argue based on the numbers, if they continue to increase at the rapid rate, then it is something that is severely justified with this company. Again, other valuation methods if you do want to take a look, but that is the main one for now before we jump into the valuation model. We then have the growth grade. Well, A+, the best grade that you can get, and pretty much all across the board. Year-on-year revenue growth, triple digit. Sector median, low single digit. Forward looking, still looking like very strong, 73%. Sector median, just under 7%. And we can see that is expected across all of these growth metrics. The other one I want to point out in terms of the forward-looking earnings per share over the next 3 to 5 years, 35% year-on-year growth, with the sector at 13.55. We're talking much better by around 159%. Now, yes, this is the expectation. Doesn't mean they will hit it. But if that is what they are looking to achieve, then again, this could be one to warrant. Not necessarily to buy at current prices, but definitely to consider for the portfolio. We then take a look at the profitability grade. Again, another very strong metric, A+. Gross profit margin, so these are trailing 12 months, 73%, sector median fairly high at 49%, but still NVIDIA smashing through. And we're going to discuss this shortly because this is a company that continued quarter on quarter, not just to increase their top line revenue, but also their margins as well. Very important for that rapid growth to their bottom line as well. EBIT margin, as well as essentially the bottom line net income margin, significantly better than that of the essentially sector median. And in terms of just wrapping up, we see a F valuation grade, growth profitability with an A+. So again, valuation is very key with this company. And we do note that Wall Street does have that very strong buy rating as well. So let's move on then to the other parts of the analysis. And now we'll move on to essentially the insider ownership and movement. Just under 4%. Now we notice 9 instances of insider selling of around 347 million, and this is over the last 12 months. When we look at quarter on quarter, 20 million shares sold in Q2 of 24, 75 million in Q1. And when we take a look at who these individuals are, we can in fact see the latest sale. So only a few days ago, in fact around a week ago, the director did sell over 22,000 shares when it was trading around $880 for around $20 million. We also note he did sell again not too long ago, the 28th of March, 11,000 shares, another tranche, just over $905 for just under $10 million. So he's already banked around 30 million, but as always, insider selling, it is really dependent on the investor and their own thesis if they include it as a negative bearish signal. But just remember, they do sell for many different reasons that we're not always aware of, whether that's personal or financial. We then do a very similar analysis, but on the institutional ownership, 65%, just under 50 billion worth of sales by the institutions, and a significant amount more over the last 12 months, 670 billion, with in the Q1, the latest quarter of the data set we have available, 18 billion buys versus 12 million sales. So we can clearly see here that institutions, not just over the last 12 months, but also over the last quarter, they are buying a lot more shares than they are selling. Now, what I quite like to do is just revisit some of their slides from their latest presentation. We will take a look when they do release new ones from their earnings at the end of the month. But as we mentioned, firstly, they're increasing their top line at a very rapid rate. Always great to see regardless of the company, but what I really want to point out here is the fact that not only has it increased dramatically just over the last 5 years, in fact nearly 6 times as rapid, but we also note their margins year on year have been improving over the longer term. 34% was the operating margin in FY20, 61% in FY24. So this is a company that we will see become more and more profitable if they can continue this trend. And finally here, this graph really depicting the fact that a lot of this growth to their top line is being driven from this color here, the data center going from 40% to 78%. And this will continue to increase with AI, especially the different products they are looking to bring out and increase their income streams, which we will shortly touch upon. That was the operating margin. In terms of the gross margin as well, we do see over the longer term, it is increasing on average around 67%, but we note FY20, 63%, FY24, 74%. So lots of positives, and we will be eagerly looking at these numbers in their latest investor presentation to ensure they are continuing at a bare minimum to maintain the same margins quarter on quarter, year on year. And this is just really discussing the free cash flow, very important metric. We'll come into it in a lot more detail shortly, but with every company you invest in or consider, they have to increase their free cash flow year on year. It is a very important metric to understand and acknowledge. It should be part of your own investment thesis. One thing that maybe isn't discussed as much is the fact that they have done a fair amount of share repurchases. As we can see, 9.5 billion in FY24, 22.5 essentially remaining as of the end of Q4. So this is something they are continually looking to do. And also, although very meaningless in my opinion, they are continuing their dividend, but they only plan to maintain it. It is very marginal, but again, just wanted to mention. Now, one thing that I do like to talk about, something we haven't covered before, is a 1 trillion long-term available market opportunity. Now, they talk about the different ways that they are able to essentially implement this within their own business model. We have the gaming element, 100 billion. We have the data center systems, 300 billion. And then we have others here. One very important thing, the autonomous machines, and they are essentially referring as well to robotics. And we can see here the Omniverse enterprise at 150 billion. Now, the reason why I wanted to draw this out is just for those people who look at this company and say it has increased so much year on year, quarter on quarter. Where is the growth going to continue? And remember, this will make up some of the valuation that we process later on, but there are the opportunities for them to continue. And this has not just come from NVIDIA, but also an article not too long ago, something we have discussed before, but they also reaffirmed that generative AI races towards a 1.3 trillion revenue by 2032. And we can see this is a big boost for sales for tech companies, not just hardware, but also software, services, ads, and gaming segments, which NVIDIA also cover. And when we take a look at this in terms of a graphical format, we can clearly see here that over the longer term, it is looking to increase. And if NVIDIA can capture this within their own business model, which they have been doing, then again, this will be very positive for this company. Now, before we look at the dividend safety, as well as running through the free cash flow, we just want to make you aware, we have released our latest free weekly article. If you want to gain access to this or any others, all completely free, do click on that pinned comment below. You can start reading. It is instant access. And we'll just draw your attention to this article here. If you are interested in learning where we get our websites from, the resources, what we use, it is all discussed in here and all completely free for you as well. So also just want to let you know from essentially one of their later presentations at one of their meetings, they did announce the NVIDIA Blackwell platform, which although this isn't essentially my own target in terms of the information, we can see it is a very, very new super chip, and it is one that will hopefully empower them to bring up more revenue in their quarter-on-quarter release. So excited to see how this will affect the company moving forwards. And we can see some of the uses for these products that they do have is around robotics. It is one area that we did see not too long ago. In fact, here, autonomous machines and robotics, 300 billion in terms of the market opportunity, which they are capable in taking. And we can see it is something they are looking to do moving forwards. So it will be interesting to see how this does affect their numbers moving forwards. So let's take a look at some of the underlying metrics. Now, dividend safety, very briefly, 89 score, very safe. The yield is very minimal, 0.02%. Market cap 2.21 trillion. They are a mega cap company. And when we do look, their dividend safety was recently reaffirmed, suggesting a dividend cut is highly unlikely. And as we mentioned, they are only looking to maintain it from their latest presentation. Now, they didn't pay a dividend during the last recession, but what we do note is the sales were negative 35%, below the average of the S&P, which was around negative 12. And they also trailed the S&P negative 78 when the S&P itself returned negative 55. Dividend growth, no surprises. They haven't increased it since 2018, as we just mentioned. And over the last 5 years, it's increased 1% year on year. Over the last 10 years, 8%. But let's be honest, you really wouldn't care as an investor given how rapidly the share price has increased over the same period. And they have been paying a dividend for the last 11 years without a reduction. Now, typically on the channel, we do look at dividend yield theory to understand undervaluation. It would be undervalued if the yield was above the 5-year average. But again, not one we will use for this type of company. What we will point out though, however, is the forward P of 36.5 is lower than the 5-year rolling of NVIDIA of 41.3. And we also note it is significantly higher than the information technology at 26.3. Now, we're not going to cover free cash flow payout in too much detail, but we do notice 1% in 24, 1% expected next year. So absolutely no worries with that safety. It will continue to be paid unless for some reason they want to stop it. Free cash flow per share, as I mentioned, we want to invest in companies that continually increase it year on year. Whilst it did increase fairly slowly over the last 8 years, what we do, or in fact from 2015 to 2023, we do note it did increase rapidly in 2024. The expectation is it is going to essentially double into the full year 25, so lots of growth still anticipated with NVIDIA Corporation. And when we look at the sales growth, again, we did touch upon the expectations moving forwards, triple digits as well as double digits. But 2024, they increased their top line by 126%. Although 2023 was flat, even prior to that, we do see some strong double-digit growth. Now, we won't talk about the total sales. This is just another format to what we saw earlier. But in terms of shares outstanding, the net position is essentially share dilution. As we can see, it has increased. We ideally want to see share buybacks, so returning excess cash to investors, getting more control of the company. But what we do know from what we just saw in that quarter presentation, they are expected to continue the repurchase, so we should expect this to come down quarter on quarter, which is always positive for investors. ROIC, return on invested capital, as always a minimum of 10%, just to give us faith that management are able to effectively allocate their capital. Significantly above that for the majority of the last 10 years, 61% in 2024, making this incredibly attractive to investors as well as those potential investors. Free cash flow margin, operating margin, we already took a look at the operating and it is improving quarter on quarter. In fact, operational efficiency 16% to 54% in 2024. Free cash flow margin very strong, 5% is what we want as a minimum, 45% in 2024. So lots to love about this company. And one of the most important things we're about to touch on, valuation, is key with NVIDIA. So net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, linking to both dividend safety as well as balance sheet strength, below 1.5 for semiconductors, and these numbers show us the number of years it would take the company to pay off all of that debt net of cash on hand. It won't even take them one day over the last 10 years and into next year to pay off that debt. As we already said earlier in the episode, their balance sheet is incredibly strong. So let's jump into the valuation model. And as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically we go through 4 models: Graham's valuation, multiples, the discounted cash flow, and the dividend discount. For today's episode, the only relevant one is the DCF model. Now, we have the free cash flows year on year for NVIDIA, average growth rate 94%. Now, we started off today with a low growth rate of around 22%. As we saw earlier, the expectation just into next year, it's going to double around 100%. So with the 22% conservative estimate with the discount rate at 8%, we get the present value of future free cash flows and terminal value. We then add with the cash, subtract total debt, get the equity value, divide by shares outstanding, and we can see an overvaluation signal. This is based on an intrinsic value of $822 with the market price of $898, giving us an overvaluation signal. So this is the first growth rate we have gone with, so a 22%, and as we can see, this would be implied downside of negative 8%. If we were to expand it to 24%, we can see here now the price does change to $939, and this would be implied upside of 5%. For those that believe that is too low, we can have a high rate at 26%, and again we can see this would be a price of $1,073, implied upside of 19%. Now, as always, you can grab a copy of this model to put your own numbers through, get your own estimations based on your judgments, whether that's for NVIDIA, those on your watch list, or those that you do currently hold. So we have 3, and just so you can see, for example, if you are someone who believes that these are still too low and you thought 30%, you can see the price would go to around $1,392. However, for today's episode, we are going to use the higher rate of 26% to take it through to the next slide. And therefore, the intrinsic value in today's episode, as we just mentioned, is just the DCF. The others are relevant for NVIDIA today. And this gives a $1,072 intrinsic value. So with the current price around the $900 mark, the next step is to use our margin of safety. We would use 10% as the beginning, and we only execute on these stocks at 10% level if they agree to the 3 criteria: a wide moat, a strong financial metrics, and good forward-looking data. If you believe that for NVIDIA, well, in today, it would be a 10% MOS at $965. But as always, we keep going to see what at today's price the MOS level is. And we can see it doesn't warrant a 20% just yet, but it is around a 15% MOS level up to $911. Now remember, this intrinsic value is based on the growth rate moving forwards at around 26%. And if you do believe that, the MOS of 15 would indicate a buy now. We did see earlier that Wall Street do consider this a strong buy. Now, we have a lot of analysts revisiting their prices, in fact, increasing their price targets, as we said at the beginning of the episode, $1,500. But on average, we do have a price forecast from Wall Street of $1,010. Upside implied on this price of around 12%. So as always, it does really depend on your thoughts for NVIDIA. Will they be able to keep up with how the market is estimating the progress of this company? As we did see, they have grown dramatically just over the last year. Their revenues are increasing. Their margins are also increasing. They're also bringing out new products. They have new chips, as we saw Blackwell, and they are also looking to expand into other areas as well, robotics being one of them. So it will be interesting to see how this company shapes up over the short term as well as the longer term. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop, and let us know your thoughts below. As always, don't forget you can click on the pinned comment so you can grab a copy of this model and run your own companies through, or those on your watch list, or even just run this through based on your own numbers. As always, we'll see you all on the next episode, and for now, take care.